Hey, everybody. Finally, we made it. Part 6. The final part, the piece that pulls it all together, producing income in retirement. We've talked about so much. This is the most pieces I've turned one of my classes into. So let's jump in. This is trying to bring it all together. How do we apply these tools? And I say do your homework, because really we've got to look at every individual situation and try to pull together all the things that make you different and create the most tax efficient way for you to fund your retirement. And that's what this is all about, pulling all these strange pieces together. We start with things like your budget. We got to understand what it's going to take to fund your retirement. Okay. And then once we understand your budget, then we have to start scrutinizing things like income. Okay. How much of our guaranteed income is going to take care of all the I needs and I wants, right? At minimum, we always prefer those guaranteed income, Social Security and pension income pays the I need bills, right? The real base living retirement necessities. Then beyond that, it's icing on the cake. It makes the world a lot easier if you've got lots of income. But too much income can cause problems, creates inefficiencies, and doesn't allow you to keep up with inflation, right? Because most income is flat. And if inflation keeps going, then your flat income is not enough all of a sudden. So that's why we've got to have a little bit of everything. Okay, so guaranteed income is wonderful. But if you get a whole bunch of income that you can't control and you don't have any need for, you still got to pay taxes on it. So having some passive income and the ability to withdraw from your portfolio, whether the market's good or bad, that is important. So understanding our needs and then kind of matching up that guaranteed income with the bills, and then deciding how much of the passive and withdrawal type income we're going to need beyond that. Then we have to start looking at more the efficiency side of this. What kind of money do you have saved? Right? If all your savings is Roth, no matter what we do is tax-free. So we're going to be as efficient as possible at that point. But what if all your money, all your savings is IRA? Well, then we have to pay more attention, because at some point we're going to be forced into these required distributions, which means we need to be more proactive. We need to understand taxation. We need to be withdrawing money and maybe converting it to Roth or prioritizing the use of it. So that becomes really important, understanding the amounts of money you have in each of these categories. And then there's the tax brackets, and where you lie in those tax brackets, matching up the money we can't control, that guaranteed income, with our tax brackets and deciding how much income we need beyond that and how we're going to achieve it. Are we going to utilize less taxable forms of investing, things like long-term capital gains and qualified dividends, maybe municipal bonds if you're in the higher tax classes? There's lots of things that we have to take into account. Okay, so we have to go through and individualize this and make sure that this is as efficient as possible. So there's a few things we have to live by. One, for efficiency, you have to think about retirement in a different way. Your bank account, right? Your bank account, you've got your Social Security paycheck, your pension paycheck coming in, you're paying all your bills out of there. If we assess how much you need above your paycheck, we should be filling that bank account with that extra money for a whole year. Okay? This is the flow of money. And then only once a year, and typically towards the end of the year, you're going to reach into those investments and you're going to refill that bank account. That's how you're going to fund the retirement. You're going to scrape those dividends, the passive income off first. And then if you need more money, you go to the withdrawal investments and pull from those. Okay. So the principles that you live by, the higher your dependence on your portfolio for income, the less it should be left to chance. The larger your withdrawal rate, the greater the effect of volatility. And it goes back to this retirement's hierarchy of needs, building that investment portfolio that's right for every individual. You go back to the foundation of a good retirement, and that foundation is always going to start with guaranteed income. Do you have enough to pay these base living expenses? That comes first. Solve that problem. Make sure that you have enough. Then 1 year's worth of money that you need above this income. Okay. So a little cushion for emergencies and the fund money you need for a whole year. Then the safe investments that are usually known as the withdrawal income investments, right? Safe, stable investments are much better to withdraw from. We have to go back to math to learn why, but just they are much better. Okay. And then you've got the stock market side of the investments, the more passive income type investment strategies. Those are the dividend paying stocks, the REITs, the preferred stocks, bonds, CDs. We consider all that stuff that passive income world. And then whatever's left, go have fun with it. You want to, do speculative investing with private investments. Those private REITs promise 10, 12, 15% returns. They're all wonderful. And if you have more money than you need for yourself, fine, go play with that stuff. Otherwise, stay away from that world. You want to get a rental property, you want to get this, you want to get that, go for it. I don't have a problem with it as long as we're doing it after we've taken care of ourselves. All right. Hopefully that rounds it out. I know that was a short one and a brief one, but it's part 6. I didn't want to keep you for 20, 30 minutes. I wanted to make it quick and easy because honestly, part 1 really talked about the things we all have to consider when transitioning into retirement and how investing changes. And then we really dig into what makes you individually different than everybody else and the different types of income tools. So we got to make sure that we pull this together as everybody is an individual, and we've got to make sure it's cohesive and efficient in your situation. This is the fun part of financial planning. This is the fun part because it's a puzzle and everybody's got a different puzzle, and putting all the pieces together is what creates an efficient retirement. It makes your money last longer, makes you pay less taxes, makes more money for you to go play with. So really important that this gets pulled together properly. Certainly, if you need any help with this is what I love doing. This is one of my favorite things to kind of work through in every individual situation, is how to create that funding of retirement in the most efficient way possible. Let us know if we can help out. Shoot us an email, give us a call. Always happy to help out in any of this stuff. Over Zoom nationwide or in person in Arizona, as always. Share, like, subscribe, check out some of the information below. We're going to start linking reports and all that kind of stuff in here as well. Thanks again. We'll see you next week.